I feel like all of the tensions, the shocks, the geopolitical wrangling is distilled here in Davos. How worried are you about the ripple effects this could have on the world economy?
You know, I've been having many conversations with clients and political leaders, and what you see is there's a great kind of urging both clients and political leaders to say we need an honest discussion about the real security issues around the Arctic, Greenland, and with some specificity to identify what the critical security issues are, and so that you can enter into a dialogue that leads to solutions ultimately within the context of NATO. I think that's in many ways, the litmus test here. And so people are worried. The consequences, I think, both geopolitically and economically are significant depending on the outcome that, we'll end up seeing in the months to come.
But is there any doubt in your mind that tariffs are being weaponized? And if that's the case, it's very difficult to model, actually.
It is hard to model. Economies are good at adjusting. One of the things I've learned as a central banker is you always underestimate the degree to which companies will adjust to changing realities. And there's no question that the world has changed. This is probably, I was thinking about this morning, probably the most challenging moment in U.S.-European relations since World War II, or certainly one of the most challenging moments. And markets will see what the new equilibrium is. I think it's pretty clear, again, when you speak to our clients and leaders, that there's a general consensus that the old order that has shaped the world for the last 60 years is no more. And so the question is, what new equilibrium will we move towards? And there are many different outcomes that one can imagine, and depending on where we end up ultimately, we could have very different outcomes in the economy and in markets.
So how do you look at this new world order? And I know you say there are different, way of looking at it, but what does it mean for the deployment of capital and financial markets and where they need to be positioned? If we're seeing blocks that are based on geopolitical thinking or alignment on the political front, then it is going to be a very different world, but it'll also be different in terms of financial markets.
Yes, I think much will depend on the ability of Europe to essentially take advantage of the very large economy it is. If you look at the European economy, it's vast, right? The question is, can it come together? Can it enhance competitiveness? Can it address the issues that Mario Draghi identified so clearly in his report? This is no longer about diagnostics. We know what the issues are. Can Europe rise under pressure to come up with the right answers to be one of the important blocks going forward? That would be, the most likely scenario, I would say, still today, that under pressure Europe finds these answers and then is able to be one of the important geopolitical blocks going forward. You could have very different scenarios where you have much more fragmentation, which again would be quite a different world from a financial market perspective. But I would say the most likely scenario at this point is that Europe rises to this occasion. That's certainly what our European clients, European policymakers are striving for, or hoping for. And then you end up with Europe being a player. And then, as you saw, Prime Minister Carney yesterday talking about the middle powers. So you can kind of see a world order, but we don't know where this ends up. I think we are in a period between geopolitical orders, basically, and that's always a period of uncertainty, some volatility, and questions as to where we ultimately land.
Philipp, are we too tough on Europe? Because I hear, especially around, the Davos corridors, a lot of European leaders saying, look, we have 3,000 years of history. We kind of know what we're doing. People actually want to live in Europe compared to other parts in the U.S. So actually, the U.S. economy is doing so well because of threats. So people move manufacturing. I mean, surely we don't want Europe to do the same.
I think Europe has tremendous potential. There's no question about that in my mind. I'm perhaps somewhat biased. But when I say potential, we have enormous potential in addressing things that are relatively easy to address. Again, Prime Minister Carney, in a very noted speech yesterday, was describing how he has eliminated interprovincial barriers, trade barriers. That alone in Europe, again, this has been identified by Mario Draghi and others, has enormous competitiveness potential. So these issues are, some of them are hard to tackle. Deregulating is very difficult in the European context. The European apparatus is slow by design and not always the most efficient one. But other things can be done quite easily. So I think there's a reservoir of measures that would dramatically enhance Europe's competitiveness. So I mean, I agree that there is tremendous potential, and we shouldn't be too pessimistic going forward.
How are clients behaving? Are they changing some of their behavior? I don't know whether they want less exposure maybe to U.S. assets. Is there a de-dollarization theme going on?
I would say if you look at the period since the great financial crisis, the dollar has done, the U.S. has done incredibly well. This reflects itself in the fact that today 60–70% of the capital markets is U.S.-based. So most global portfolios came into last year being, structurally long the dollar. So you did see some adjustment, but I think that probably would have happened anyhow to some extent, given the degree to which most portfolios were long. And now the market, by and large, when I speak to clients, what I see is a sort of uncertainty, concerns, and worries, and you essentially wait and see what this new world order will look like that we're moving towards. This is, my guess is we will look back in 20 years at 2025, 26 as one of those pivotal years in the post-war period where things change. What we don't know yet exactly is where it ends up. And hopefully all this, I mean, the one echo I get from clients and leaders, frankly, is that whatever issues we have, we must try to solve them in the spirit of a dialogue, focusing on specific issues. What are the specific issues that are leading to this tension, and try to address them? And
we haven't even touched on AI, but do you worry about central bank independence in the U.S. and what that could do to the markets?
Well, central bank independence, and more importantly, the achievement of central banks, namely price stability, has been an underpinning of the post-war economic order, or certainly not the entire post-war, but the last couple of decades. So there is value in this, undoubtedly. But what we're seeing at the same time today, we have many other structural forces that are really coming in. You mentioned AI. When you look at the AI, broadly defined, has led to something like 40% of GDP in the U.S. in the last year. So there's tremendous potential in these investments around AI, data centers, infrastructure, energy, that could really enhance the growth potential. And ultimately, this will be the most important thing. We need to find ways to enhance growth. Given the debt levels that most countries are in, and the vulnerabilities of many countries in terms of their fiscal situation, we saw signs of this even yesterday in Japan. It is essential that we find ways to enhance growth. The investment spending that we're seeing, tremendous investment spending around technology, infrastructure, energy, has the potential of raising potential growth. If that happens, many of the problems that we're facing will be solvable.
I did a big panel actually yesterday on how to get growth, and I had Mark Benioff on it, I had Ruth Porat and others, and I think one of the conclusions was that you need inclusive growth, because you can have good growth and great numbers, but if half the people are left behind, then that's going to be problematic.
That is clearly, and that's, as you see, has been one of the themes that Larry Fink has really, I think, brought into this year's discussion. We need to find ways to do this, and AI, of course, is critical, because how do these technological innovations, how do they spread into the economy? Who benefits? Which companies, by the way, benefits? Also a very big macroeconomic question, a big asset allocation question, and then ultimately, how do you spread it into the workforce, into the population? I think that will be, from a kind of human perspective, and you heard some of the leaders now talking about this more and more. Ken Rogoff talked about it, but also some of the CEOs of the hyperscalers. This will be one of the critical issues. How do we make sure that these benefits kind of spread through the population?
I mean, are companies, do you see companies changing fundamentally when CEOs talk to you about AI?
I think what I see is new. Obviously, we had a big hype around this last year, but what I find is new and encouraging this year. For the first time, you're beginning to see some of these questions being addressed. What does it mean for our children? What does it mean for the future workforce? How do you make sure that you have a population that supports the system? And of course, some of this is happening in the context of the populism that we're seeing rising in many countries. So there is I find a promising new focus by the tech leaders themselves on some of these secondary issues, in a sense of how it will impact humanity ultimately.
I mean, away from how it impacts humanity, how do you think it impacts financial markets? Are we in a bubble?
Well, it has had a huge impact on growth. First of all, as I mentioned, depending how you look at this, close to half of GDP growth has been related to, broadly speaking, AI. It has huge potential in raising growth. And if it does that, then the market pricing that you see will be justified. We will be able to deal with the high debt levels. We will be able to have growth that is not particularly inflationary. If some of these expectations are not fulfilled, we'll be in a very different world of stickier inflation, of lower growth, bigger debt problems, presumably more significant political issues. So it's a very important issue on how this potential, this ability in principle of these investments to enhance productivity, push up potential growth, I think is in a sense, the critical macroeconomic question, which will have huge repercussions on financial markets.